Good afternoon, and welcome to today's webinar, Examining KYB, What's to Come and How to Prepare. My name is Mélisande Mual. I'm the publisher of the Paypers, and I'm delighted to be the host of today's webinar with our partner, Trulia. Trulia provides a global identity marketplace that services a wide range of industries, including finance, banking, retail, payments, gaming, and online marketplaces, all through a single API integration. And thank you so much for joining today. It's great to see so many of you tuning in from all over the world. So what's the story? In a world of instant cross-border business transactions, it's clear that the future of online payments is moving towards technological adoption. But despite this growing digital demand, organizations must take action to avoid a massive fraud crisis. Because while digital payments offer faster settlement times and lower costs compared to traditional payments, they run the risk of poor onboarding techniques and light know-your-business routines. And bad customer experiences, lost customers, and decreased revenue is problematic for all parties, not to mention the compliance risks involved. But there are technologies out there that can help automate the process, speed up onboarding, and control fraud, and eventually enable regulated entities to provide an onboarding user experiences their business customers expect. So today, experts from Trulia and Flagship advisory partners will help you understand the payments landscape, issues and solutions around business payments and KYC and KYB. But before introducing the two speakers, I would like to start with some quick notes regarding housekeeping. The webinar will take 40 minutes, and we will have approximately 10 to 15 minutes for a Q&A at the end of the discussion. So on the right side of your screen, you can see a chat panel, which includes a chat room and a Q&A widget. You can use that Q&A widget to ask questions at any time throughout the discussion. We will compile your questions, and the speakers will take as many as possible at the end of the discussion. So today I'm joined by Garient Evans, he's SVP Identity Solutions at Trulia, and Erik Howell, partner at Flagship Advisory Partners. So Garient and Erik, thank you so much. It's great to see you today. So how are you?
Really well, thank you. Glad to be here and excited to be on with my friend Erik.
Doing great. It's lovely weather. Always happy to talk about payments.
So great. So let me briefly introduce our two speakers. Garient Evans, he brings over 20 years of experience and expertise in credit, identity frauds, identity verification, and compliance. And prior to his current role at Trulia, he held senior roles at Mytech, Secure, as well as ID Analytics, where he was involved in releasing the industry's first identity fraud detection score, combining machine learning with PII data. So Garient, decades of experience in the fraud and identity verification industry. So what fascinates you most in this space?
Yeah, I often think the opposite of catching bad guys is allowing good individuals with good intentions to have access. And that's one of the reasons why I joined Trulia. It's had a mission for the last decade to give access to individuals around the world who normally wouldn't be able to participate in the digital economy. So that's fascinating to me, both professionally and personally. I'm an immigrant to the United States, and I know the challenges of being undocumented or underserved and what it takes to be able to participate. And that's something that drives me professionally.
Great story, Garient. And Erik Howell combines a practical experience as head of transactional banking for a publicly traded bank with deep expertise as a trusted advisor on payment strategy. He spent 20 years in payments and implementing winning roadmaps, growth initiatives, new channels, successful partnerships, and lots of M&A activities. So Erik, tell us a bit more about Flagship Advisory Partners. And do you think that this whole payment space will continue to grow?
Sure. So Flagship is a specialized advisory boutique. We serve exclusively a wide range of clients in the payments and fintech space. We do high-level strategy, market research, implementation, and a wide range of mergers and acquisitions advisory. We've done it all over the world, but our staff is based in Europe and North America. We have about 25 people. I think the thing that I love about payments and all of my colleagues love about payments is it's ever growing, it's ever dynamic, ever changing. You never get bored. But I think if you peel it back, I've been doing this 20 years, and some of the core principles are still there. Why are we doing this? Why would the customer buy it? Why do we want to enable these types of payments? Those things are universal, but everything else changes all the time, and that makes it incredibly exciting. So we think, of course, it will continue to grow. Just economies grow, people need to pay. So it's it's hugely dynamic and always exciting.
Cool. So just a quick shout out for the audience. Don't be shy. Do reach out to Garient and Erik. They would love to take your questions. So what's the agenda for today? Erik will start, and he will give basically a deep dive in the payment trends that are shaping in Europe and in the US. And then Garient, he will talk about the state of KYB and why it lags so much behind KYC. Lastly, we will talk about the predictions to future-proof your KYB strategies. So here, I would like to hand over to Erik. So Erik, please take it away.
Great. So I'll be talking about three macro trends that we see in payments. Most of these are written about in more detail in a report actually published by the Paypers called Who's in Payments 2022. So I'll give you a brief summary, but I think at the end there's links to the report, and it's a great resource. So three macro trends. One is new rails in payments. So when I joined payments 20 years ago, payments meant cards. Now, of course, it doesn't mean just cards. Instant payments, certainly in Europe, have definitely changed the game. There's a variety of alternative payment methods that have arisen in each country, many of which to solve gaps in the user experience for e-commerce and remote purchases. But even mainstream banks have gotten into the game with instant credit transfers, more advanced direct debit. And certainly there have been efforts to challenge traditional card rails. Some have worked, many have not worked. But instant payments creates a whole new swath of options, not only for issuers of payments, but also merchants and consumers. So a huge amount of activity there. I think second in the new rails macro trend is open banking. Open banking is one of those things that has gotten a lot of press. So I'm a consultant, and consultants for the past 5 years have loved to talk about open banking. I think it's evolved in ways that people didn't expect. It's still very nascent. However, I think really relevant for this audience is early adopters of open banking also tend to be those with very strong KYC and KYB needs. So you can create some really interesting use cases by being able to peek into a user's bank account once they've authorized you via open banking APIs, confirm their name, see their balance. That has a lot of great applications for things like credit scoring or just basic KYC, KYB. So it hasn't taken over the universe as many expected 5 or 6 years ago, but created a lot of new use cases that weren't expected. I think third in the new rails category, crypto really coming into its own. So certainly the market value of cryptocurrency has had some challenges of late. But if you look at the evolution of just how that overall space has evolved, currently crypto transactions are less than 5% of global e-commerce volume. And of that relatively tiny sliver, 95% is still on-off ramp with fiat currencies. But the growth rates are, of course, huge. Early adopters are, again, those that tend to have strong KYC, KYB needs, so particularly gaming and the like. But that will definitely be a much more relevant form of payment into the future, and certainly the underlying technical infrastructure behind it. I think during the past year, it's really come into its own, and where 2-3 years ago, you wouldn't hear banks talking about crypto. If you did, very negatively. And now even traditional players are starting to examine it. So that's new rails, which is an exciting new category. Second is evolving business models. So the first is what I call the rise of as a service. And this gets tacked on to a lot of acronyms. You can have banking as a service, payments as a service, cards as a service, issuing as a service, in addition to other sectors, software as a service. Everything is as a service, and those business models are converging. So for example, if you look at Europe, North America, many of the banking as a service players that will provide you with full stack, everything you need to issue payments and be a fintech. Those are devolving a bit to become more kind of best of breed category killers. So an example, Qantas now offers pure play processing. Others like Marqeta, GPS, Paymentology, kind of best of breed processors in one space that everyone wants to do more as a service, provide a holistic solution. So a lot of convergence in business models. Part of that's driven by the second sub-theme, which are payments are being more embedded into software as a service. So particularly if you look at e-commerce platforms, things that are enabled by Stripe or Adyen, but even branching out into merchant-facing accounting software packages, payments are becoming embedded everywhere. That's part of a bigger trend in embedded finance, but certainly payments make a ton of sense to have embedded use cases in a variety of software applications. And third, in evolving business models, credit innovation. So B2C facing buy now, pay later gets a lot of press, both positive and negative, but we also see really exciting applications in business to business buy now, pay later. Because certainly if you're a small business, it's really challenging to get credit. Traditionally, there existed things like merchant cash advance. Now you start to get digital factoring or digital sales finance. But all those forms of payment coupled with financing are very exciting because there's a huge swath of small businesses, both Europe, North America, other regions. They're really challenged to get access to credit. So using payments as a mechanism to get that type of credit that they need to drive their business is really high growth. And third, which has definitely been a constant throughout my 20 years in payments, is consolidation of the industry via mergers and acquisitions and a high level of funding activity. So big players always combine. There's always a huge swath of smaller players coming up. But of late, the level of M&A activity by both strategic and financial investors has been huge. That type of activity in the private market tends to lag public markets. So public markets certainly have been challenged recently. But if you just look at the deals that get announced, still a huge number, very large transactions. When you look at the funding rounds that both startups and growth stage companies have achieved, really big numbers. So it's a lot of exciting activity, although also if you peel back and look at just the raw number of startups in the fintech space from year to year, that actually has peaked about 2017. So we just look at number of startups entering fintech in the US, US and Europe 5 years ago versus today, it's significantly smaller. So I think it's not exactly a bubble that's about to burst, but certainly there has been a natural decline in startup activity, although those former startups have gotten quite big. Huge funding, huge M&A activity. So the industry, as I mentioned at the beginning, continues to evolve, continues to be really high growth, extremely dynamic, but some things like M&A activity never change.
Yeah, cool. And Erik, you told us a bit about these macro trends in payments and also highlighted KYB and KYC, whether we talk about crypto companies or open banking. So Garient, what is going on in KYC and KYB and why is it so important?
Yeah, absolutely. And just want to acknowledge that my origin story started with Erik years ago in the payment space. And since then, I've spent the majority of my time in identity. And what we see is that markets that have developed credit bureaus or registries tend to have really robust capabilities when it comes to lending and to some of these as a service technologies and really developed technology sectors. And part of that is the availability of consumer data allows you to interact digitally in a safe and transparent way. And so when we think about the KYC versus KYB markets, we would say that KYC is somewhere in the neighborhood of 10 to 15 years more advanced than what we have for business verification. And these KYC regimes really fall into two buckets, just like they do on the business verification side. On one side, you have trust and safety, and that is the availability of trusted third-party data to confirm the authenticity of a consumer or business when they're trying to onboard or transact. And then the other side of that, the opposite of trust and safety in a lot of the work that we do is a government or regulatory obligation, kind of a check the box. And that is an activity that the regulators have said you must do to ensure that you're not inadvertently working with somebody who's sanctioned. And so I'll give an anecdote. About 10 years ago, when I was working with one of the United States' largest telecommunications providers, we spent 6 months developing really sophisticated techniques to prevent fraudsters and bad actors from getting phones. And so it was really challenging for one of these $1,000 devices to leave a store or to get shipped to a fraudster. However, a small business could easily register and get 50 phones shipped with almost no authentication of that small business and no checks in place for small businesses. You know, you advance 10 years and the tools to screen businesses have improved. But I'd say that they're only as good as the local market and the registries made available. And so in the United States, state by state, the attorneys general responsible for business registries and how stringent those registries are in terms of the data that's provided. Same in many territories around the world. You have some countries like the UK that have been pushing and trying to require transparent registries for businesses. And then you have other markets that are lagging behind. So in terms of compliance, there is a challenge in verifying businesses and remaining compliant, because not every market has a transparent registry of businesses and the UBOs, the ultimate beneficial owners associated with those businesses. And so the technology lags behind the data that's available. So in terms of where we think the market will head, we think that's dependent on these registries and governments and regulators exerting their willpower to make sure that the businesses are registered and that the technology can keep up. And let me shift gears and talk a little bit about crypto. So Erik was commenting that we see these payment rails, and our clients, we have the majority of the largest crypto brokerages that we support for onboarding their consumers and their business relationships. And what we see is that often you treat crypto as an investment, as an asset, and you invest and you hold on and you see if that asset will rise. And you could, we've all heard stories of millionaires and billionaires being made by holding those assets. But Erik made the point that we can also see crypto as a payment vehicle. And increasingly, you see individuals being able to buy and trade goods and offer services using crypto. And these could be fractional amounts of Bitcoin, or they could be these new stable coins. And so now increasingly, it's not proliferated. We're not all buying our sodas using crypto, but you see a lot of startups offering crypto payments, and then you see traditional entities now participating and now allowing for the use of crypto. And what implications does this have for KYC and KYB? Well, first of all, let's do a little myth busting, and that is crypto is not anonymous. To participate through the majority of vehicles now, you must go through a KYC or a KYB process, and that's typically to convert fiat, which is the currency of your country, to a cryptocurrency. To be onboarded, to create a wallet, to be able to start trading, it requires a KYC check. Now, what you do as when you have that wallet and you begin transacting, that's typically done, your identifier is your wallet number. And everything done on the blockchain is immutable. That's kind of the point of the blockchain. So transactions that are occurring that could point towards money laundering or other nefarious activity, all of that is recorded. And so you're now starting to see articles and investigations into how money launderers and terrorist funders and other bad actors have been caught and prosecuted because these transactions are all available on the blockchain for firms to analyze and trace back to, individuals who or organizations that are trying to launder money or do bad activities. And so myth bust number one is that the crypto and blockchain is not anonymous. And in particular, the place where individuals are caught is what we call the on-ramps and the off-ramps. When you are on-ramping into crypto, that means that you're converting fiat to crypto, and you go through an authentication step. And when you off-ramp, when you want to take some of the crypto and convert it to fiat, because you want to buy something, you want to, in the real world, use some of that cryptocurrency, that's also when another authentication event occurs. And what I think the audience should keep in mind is that B2B payments are likely to increase using crypto. We find that the blockchain technology is a really elegant way for institutions to interact and in particular make contracts. So these contracts there's no such thing as a chargeback in the crypto world. Once a transaction has been made, there's no way to pull that back. And that's why these smart contracts that can be triggered based on, the delivery of goods and services can then trigger a payment. We're going to see an explosion of B2B payments in the crypto space, and the requirements for know your business, who is on the other side of that transaction, are only going to increase, proportionally.
Yeah, so that compliance burden will only increase, Garient, as you mentioned. But can you tell us basically a bit more about these UBO or registries for KYB? Because is that a sort of the silver bullet? Is that where, because they get mandated in the UK and the EU, but I recall that there's also some flaws in basically finding out, like, who is that?
That's exactly right. Yeah. And for those of you that want to know more about UBOs and the current structure of business registries and some of the flaws, go Google search Pandora Papers, go Google search the Panama Papers. These are two recent scandals that have occurred, and these are hackers that stole data from law firms and from other organizations that support the creation of corporations. These are shell companies where assets can be essentially stowed away, and the owner of that shell company, or the trust, because sometimes you can put assets into a trust, the owners of those are very, very difficult to trace. Sometimes you can have the image of the Russian nesting dolls. You'll have a corporation owned by another corporation that's owned by a trust that's owned by another corporation, and it's perfectly legal. And so the Panama Papers and the Pandora Papers show that there's individuals who have legitimately set up these structures. They've done them on offshore and onshore jurisdictions, and they're hiding assets. So for those of us who pay our taxes, who have an interest in seeing whether or not politicians or other people who are in sensitive positions might be, getting illicit goods and storing them offshore and hiding the fact that they have these assets, that's of interest to us. And the regulators say that if an institution such as a payments company or a bank is transacting with somebody who has perhaps done money laundering, or has done terrorist financing, or has done other illegal activities with these assets, they have an obligation to do something about interacting with that individual, and there are repercussions. So the pattern is, you see a scandal like the Panama Papers that show that there are presidents and politicians and money launderers who are storing these assets. And then you see the advancement of new regulations that require that if you're going to establish a business, that you have to disclose who the beneficial owners are. And so this pattern continues. So it's market by market. Some markets have the willpower to obligate these business owners to register their names and their information. And in other markets, they lag behind. And my final point is, I think what we saw with the sanctions for Russia, this issue has really emerged. As advanced as the UK is attempting to be, you also see that it's been called, a place where Russian oligarchs can store their assets and their goods. And a lot of attention has been put on European countries to interact with these sanctions and to make sure that these assets are held, or these activities are frozen. And that is a core component of Know Your Business.
Yeah, very good point, Garient. And Erik, Garient mentioned about basically sort of the regulation will continue to evolve, and the compliance burden will increasingly, become bigger and bigger. So how can payment companies future-proof their KYB strategies and stay ahead of their competition?
Sure. So I think the biggest thing we notice is making the appropriate investments in technology and the related registration to automate and digitize that. So having worked in a bank, having done KYB, as Garient mentioned, for a variety of reasons, it's a messy process. Those companies that have gotten it right and have been able to digitize and automate not only have a significantly better user experience for the customer, and as part of onboarding, they can achieve scale quicker simply because they can onboard more customers faster. Really importantly, they have significantly lower acquisition costs, because KYB is often, along with just raw marketing, one of the big components of cost. And that's when you look at CAC and how much it costs to onboard a merchant, for example. KYB is a big part of that. If you can automate that, digitize it, particularly across multiple jurisdictions, you have a significant advantage against competitors that don't. So I think the first is making sure that those onboarding processes, of which KYC, KYB is a huge part, are as digitized and automated as possible, and that there's good organizational infrastructure, new services, others, to monitor those developments across multiple jurisdictions. EU has a great advantage that it is relatively homogenous, but certainly if you're a PSP or whomever, you operate in multiple jurisdictions, so having good tech combined with good monitoring will increasingly be a competitive advantage, because the days of people sitting in the back office comparing pictures and looking through UBOs manually, the days of that are numbered, especially if you want to continue growing. So I think investment in tech and orchestration will be a big differentiator.
Yeah, thank you, Erik. And as you were speaking, I was thinking about Jamie Dimon, who's the CEO of JP Morgan Chase, who said they're going to spend $12 billion in technology. And part of that was a reaction to these neobanks and challenger banks and other startup organizations that are trying to outrun the big banks in terms of being nimble and offering consumers innovation and new capabilities. And so we are in the midst of spending war, and that is either private equity funding startups and neobanks and challenger institutions, or the traditional institutions taking some of their assets and investing back in technology. And as I think about where the future is for verifying consumers or businesses, it is in technology. And I've seen kind of a trap. And what I'll say in fighting fraud and in meeting regulatory compliance, one of the traps is that an institution thinks that they can build it all themselves. And I think of that as a trap, because there are so many good third-party solutions and capabilities out there that can allow a payment company, a merchant, a marketplace to focus on what they're good at and what their mission is, and use the technology from a third-party provider in a way that's going to allow them to be more efficient and to focus on risk screening and allowing great experiences for good consumers. And so the trap for fintechs is why build something that is available through a third party. And the one thing that I think most institutions fall down on is what I'll call orchestration technology. And orchestration is this idea that there is no silver bullet when it comes to compliance or verifying consumers or businesses. There isn't one point solution that will do it all. It's going to probably require a set of capabilities. And as you look across the world now, you have government-issued document verification emerging as one capability to authenticate an individual. But if that's the only thing that a company uses, that is too bad, because there are many other things like device intelligence, biometrics, behavioral analytics, the use of PII to authenticate an individual. There's a host of capabilities. And the idea is to layer them together, use them in an intuitive way to create friction for individuals or businesses that pose risk, and to ease the way for folks who are easily identified and represent low to no risk. And orchestration technology is really the key to that. So a company should not fall in love with one tool and hard code it, because the first thing that fraudsters do is they identify that technology or that tool or that strategy, and then they devise a way around it. So a company has to be nimble and figure out how to use multiple tools and multiple strategies and adapt as the market changes. And then to talk a little bit about business verification and why it's behind, I think the availability of data assets, is this a real business? Am I trying to authenticate the right business? There are multiple owners of franchises, for example. If you try and figure out how many different McDonald's there are and how many different business owners behind the McDonald's franchises, that's a big challenge. You might have 4 McDonald's on the same street, and they could be owned by different individuals. And so business verification is just as challenging as verifying consumers. And so the registries are typically driven by local governments. And so I think the state of the art for business verification is going to be the private sector working with the public sector to make sure these registries are transparent, that there's some kind of audit, because some registries are fully self-disclosed versus audited and confirmed information. And so it'll be a long time before we have reliable registries with audited data in various markets around the world. And then I want to talk a little bit about the interplay between fiat and crypto. Right now, if you hold on to crypto assets, you're probably a little bummed, a little upset because crypto markets have tanked recently. We anticipate that they will see various fluctuations. They will go up and down. Part of that is because there are many fewer protections in place. There are many fewer regulations in place for crypto assets compared to other asset types. And so, buyer beware if you're going to participate in the crypto space. You even see these stable coins, which are meant to be pegged to currencies, traditional fiat currencies. You see them being disrupted, and they are in fact going through similar roller coasters in terms of valuations. And so even though it's a tumultuous time right now, we think that the underlying technology of blockchain is just at its infancy. You may call it the Web3. This is the idea that there are going to be whole new ways of paying for or investing in assets, that marketplaces will be migrating away from traditional Web 2.0 to Web 3.0, which means that they're going to be using the blockchain. And it presents a whole host of new capabilities, such as smart contracts. Let's say that Trulioo wants to work with Flagship on an advisory project. They deliver, using Web 3.0, a presentation to us, and that triggers, the invoice for a smart payment back to Flagship. We think that's the way that these blockchains will be used increasingly. But that also means that before we do business with Flagship, that some kind of business verification is going to occur up front, so that some imposter doesn't pose as Flagship and then steal the payment illicitly. So we think the use of blockchain is only going to go proportionally with the needs for verifying the consumer or the business that's on the other side of that transaction.
So basically, Karen, sort of to future-proof, you mentioned technology and the ability to orchestrate different solutions. Don't choose one, but use on multiple solutions out there. The need, and I think that's an important point of the collaboration between private and public registers, to really get a single point of truth.
That's right.
Which is not self-supported, self-reported, but verified. And then lastly, the crypto space and more specifically probably the applicants of blockchain in KYB and KYC. That could be a future technology, or it's a current technology that could really be valid for this space as well. So great points. Let's we talked a bit in our discussion about two reports. One that was referred to by Erik, and thank you for that, is the Who is Who in Payment report that was just launched this week. You can find these reports in the handouts. They're free for download to you. These reports basically talks about all the relevant payment trends, the relevant players and startups to watch. And there's another valuable asset from Trulioo about the sixth AML, and it basically gives an overview of the threat landscape and the AML risks in the EU and the best practices for evolving CDD measures in a response to this new directive. So do take a moment to download these two assets. And before we go to the questions, I would like to ask Erik to tell us a bit more about Flagship.
Sure. So as I mentioned before, Flagship is a boutique advisory firm. We serve effectively all types of players in payments and fintech. We do a wide variety of market analysis, strategy, classic optimization, can implement, and we do a great deal of M&A advisory. We have 25 people based in Europe and North America, but we do work all over the world. So we've covered LATAM, Asia Pacific, Middle East, North Africa. Our key selling point is really deep expertise. So the senior leadership team has been doing this for 20 years plus. Garient and I go way back in our advisory days. So we know an awful lot about payments, but not only do we know a lot about it, we can apply it. So practical recommendations. And having done this for a long time, we know what works, what doesn't, what's important to keep on the radar. And as a small firm, we're really personally committed. So love to work with you. Happy to help. It's great always to talk to Mélisande. We put a lot of our views into the paper that Mélisande mentioned, the Who's Who in Payments report 2022. So I would definitely encourage you to give that a read. It's got a lot of great resources.
Okay, thank you, Erik. And Karen, tell us a bit more about Trulia as well.
Yeah, and I can't help but give another commercial for Flagship and Erik and his team. As I see their content published on LinkedIn and other forum, I'm astonished. I don't think there's no way there's 25 people at Flagship. The excellent analysis and the details that you get from them, really astounding. So I'm thrilled to be able to chat on this topic with Erik and his team. Trulia has been around about a decade, and our mission has been to allow individuals to participate in the digital world. And one of the big challenges for them is the lack of authentication, the lack of the ability to be identified so that they can open an account. And so we've been taking on that challenge and successfully have put together 400 different data sources in 195 markets. Those are countries and territories. And so what that means is if somebody wants to open an account with a bank, participate in payments, wants to sell their goods as a merchant, we are providing the ability to use a trusted third party, such as a government registry, credit bureau, a utility, for that individual to be authenticated and participate in that space. And that used to be just centered on consumers. But increasingly, our clients have said we have challenges verifying our suppliers, our merchants, the businesses that we want to onboard. And so we've been developing those know your business capabilities now for the last 5 years. And I've been keeping an eye on the questions, and there's a lot of questions about where are these data sources available? What is possible for the automated onboarding of businesses, and how reliable are those services? Although they lag behind the state of the art for consumer verification, And it's more complex because it's often not enough to just verify the business. You want to verify the controlling parties of that business, the owners or directors, or identify the percentage owned by that individual. It's a multi-step review. Today, most companies are doing it in a manual way. And so Trulioo has been innovating, working with the leading data sources around the world to figure out how to automate that, and then how to return intelligent information that's been deduped and is reliable, so that there could be a manual review after the initial automatic screening. So that's where we've spent the last 5 years trying to create these global solutions, and we're excited to share more with the audience.
Cool. Thank you so much, Garient, and thank you also, Erik, for sharing all your insights. And I can't agree more with Garient about the value of the data and the analysis of Flagship. Happy to start with the questions. Garient, what is the coverage of the data? I mean, you mentioned you bring a global database, but is that across all regions? What is the scope?
Yeah, let's start with, we have a government-issued document verification solution that works everywhere there's a passport that's issued. And passports they follow a consistent template. And so if there's a passport, we can verify it. And then you take a look at driver licenses or national IDs, and we're able to verify those. And those also have consistent templates. There's always new ones coming out, but we are able to authenticate those around the world. We have a network of PII, personally identifiable information, that we can verify globally. There are some markets that are nearly impossible, particularly because there are no publicly available data registries for consumers or businesses. And so if you ask us about Saudi Arabia, for example, we don't have a data source to verify consumers or businesses there, and we're not aware of publicly available registries in those markets. But for the last decade, we have been investing in the developed markets. So most of Europe, we have access to. Most of Latin America, Asia is a very strong market for us in all of North America. South America and Central America is emerging. We have most of the countries covered with multiple data sources. And I noticed that there were some questions about our opinions and thoughts on the Latin American markets. I think we can see multiple fintech and challenger bank and payment companies that have emerged that are success stories already. And I would say that Africa is a place that is emerging, and we're starting to see companies like Flutterwave and others emerge as success stories and unicorns in the African markets that are really worth paying attention to and are helping us develop, reliable data sources there.
Yeah, you spoke about willpower, Garient, of countries to basically build these registries. But what do local governments and regulators do or may do to help streamline the available data and its reliability? Could you talk a bit more about that?
Yeah, let me tell a tale of two countries, and I'll pick on the United States as a place that perhaps is unintentionally a little bit hypocritical here. The Panama Papers and the Pandora Papers, if you take a look at them, they show that in the United States, South Dakota has the equivalent transparency as in many of these offshore countries that are typically associated with these trusts and shell companies. In South Dakota, you can establish a shell company and have zero transparency in terms of the ownership and the ultimate beneficial owners. There's multiple states in the United States that have similar setups. And so with the Pandora Papers, you saw that there were presidents and prime ministers of third world countries that had millions and millions of dollars in corporations in South Dakota. I believe Wyoming is also a state that has a similar structure. And it was a scandal, but the US so far has done nothing. And there's been no response to shore those up or to create transparency. Similar you see a lot of anti-money laundering regulations in the United States. We're outraged about the Russians who have been able to have millions and billions of dollars, and you wonder where they came from, these oligarchs. But for example, real estate transactions and art and antiquity transactions in the United States have no obligations to report suspicious activities or to authenticate the individual. So you can buy a piece of real estate for cash, and the broker or the individuals who are associated with that transaction have no obligation to report that. And no obligation if, for example, a corporation buys that piece of property or that piece of art to establish who the UBOs are. So the US has a long way to go in shoring up some of these gaps. But you look at the sixth anti-money laundering directive from the European Union, and that is a kind of the opposite side. They've increased the definitions, made it clearer what it is that they're talking about in these regulations. And they've also upped the ante. Something that we should all be aware of if we're transacting in Europe and have payments being initiated or settled in Europe is that the criminal liability for a department that is knowingly or unknowingly working with a money launderer or a terrorist funder, somebody could go to jail. And the key part of that is unknowingly. So instead of there being some kind of conspiracy to transact and interact with a money launderer, you could just have a gap in your processes, and that could be sufficient for officers or individuals associated with that control program going to jail. So the European Union is definitely taking this seriously, and we could see that in the establishment of more UBO registries and more transparency in business verification.
Brilliant. Generic question about KYB. Is that mandatory or is it good practice? Maybe also in the context of underwriting merchants or
it is mandatory when it comes to meeting your regulatory obligations. And so and I'd like to defer to Erik to talk a little bit about the payment space and business verification. But when you are participating in the traditional payment space, it's regulated, and banks typically are audited and reviewed to make sure that they have compliance programs in place. And that includes understanding what business you might be interacting with and the individuals behind it. But Erik, perhaps you can comment on that.
It is. So certainly in the US and Europe, payments transactions take place through regulated entities. In Europe, payment institution or e-money license, and the US banks. And as regulated entities, they do have to do full KYC, KYB on all their customers. And definitely when you look at any type of payments company, if you were buying a payments processor or PSP, a big component is always reviewing the KYB processes, making sure they're up to snuff. Other jurisdictions, maybe a bit less, but certainly in developed markets, it's a huge component of the business because it is mandatory. There's no way around it.
Okay, clear. Next question is about KYC databases. Will a KYC database ever springboard to payment networks?
100%, yeah. And I can say with authority in interacting with some different payment service providers, they are interested in being offering their customers a full suite of services. And so today, many of these reviews are being done by third parties. And so the largest payment providers and payment service companies are talking to Trulioo saying, what can we do to bring forward the screening of these individuals and these transactions so that our clients, be they the banks or the merchants, don't have to do it themselves, and they can take advantage of our scale and ability to provide these insights back so that they don't knowingly or unknowingly interact with any of these sanctioned individuals. And so, yeah, we see that coming. I think the thing that we're also helping them with is the idea of onboarding merchants in an automated way. And so you can go to some of these payment companies today and you'll see roomfuls of underwriters. These are analysts who are individually and manually reviewing applications by small businesses to get merchant services. And so that's why I say that it lags behind the KYC technology. There's still these manual applications. And so our ability to allow for automated review of business applications and for those to be transparent and low risk for these large payment providers is one of the challenges we're taking on here in the next couple years. And Erik, you smiled when I said that. I think you probably have seen still some of these manual processes.
Yes, I've even literally done them. So it's a hard thing to automate. KYB, if you are, for example, onboarding a small business who's a sole proprietor and therefore has one UBO, that's fine. But just literally the process to underwrite a legal entity that has more than one beneficial owner or other subsidiaries is incredibly complex. So even practical experience when I was at a bank, we digitized the SME, sole proprietor onboarding, but said no to the legal entity onboarding because it's too complex at that time. So, of course, we didn't have Trulioo's technology.
Thanks, Erik.
A bit about the future. Do you see any role for blockchain as a technology to create trusted registries, especially for interoperability between jurisdictions or where there may be distrust in central jurisdictions?
Do you want to try that one, Erik?
I think generally I would say yes. That is one of the theorized use cases. I'm trying to stretch my brain cells to see if I've seen an example of that live, and I can't think of one. But definitely that is one of the theoretical use cases, and I think the tech and the business case needs to evolve there. But I would expect, within the next 5 years, yes, because it meets a core need. You need registry, you need both parties verified, and particularly in jurisdictions where that kind of natural trust is low, that does fulfill a key customer need.
Yeah, and thank you, Erik. I agree with you, and I believe it's inevitable. But today, I'll comment that there's two different sets of infrastructure for crypto exchanges. You have centralized exchanges, the Binances and the Coinbases of the world. That's a centralized exchange. You interact with them, you create a wallet. That wallet gives you access to buy different types of cryptocurrencies, and you onboard with a Binance or a Coinbase. They will keep your personal information for regulatory purposes, but you have an anonymous wallet with a wallet identifier, and then you can transact using that wallet identifier. And where we've seen the market evolve is that you have a wallet reputation. And so we see other crypto brokerages, when your wallet comes in and you want to transact with them, they are using third-party technology to essentially take a look at every transaction that wallet has done, to see if that wallet has made payments to known bad wallets or suspicious transaction amounts, other patterns of behavior. And so now you have a wallet reputation that can indicate whether or not you want to actually transact with that wallet, or you're going to have some special care and handling with that wallet because it's been associated with bad activity. That isn't through the central brokerages, but you also see the emergence of something called DeFi, which is decentralized finance. And these are basically, they allow you to do peer-to-peer. You want to interact with somebody on the blockchain and transact with them. That is the Wild West. And so you see thousands of DeFi companies, and it's not centralized. They are not keeping your information and authenticating you when you onboard. Often DeFi companies require centralized finance to allow you to onboard fiat to crypto, and then you can transact with DeFi. But it is the Wild West by definition, by design. It is meant to allow anonymity and transacting with various types of currencies. And so what the benefit is that freedom, but the risk is the lack of consumer protections, right? So most of us have grown up feeling very comfortable that our bank or our payment network has a set of consumer protections, that if I accidentally send somebody extra money, that there's some kind of chargeback or control in place,
Mm-hmm.
or that the company will make me whole if my wallet is stolen. That is not the case in DeFi. And so we observe it, we understand it, we see it grow and develop, but we also are aware of the risks there.
Okay, well, thank you, Garient, and also thank you, Erik, for taking all the questions. Thank you for the audience to tuning in today and for engaging and interacting with Garient and Erik. For now, I wish you all a very good rest of the day. We will send you a link to the webcast shortly, and hope to see you next time. Thank you.